You're about to join Jerry Parker, Moritz Siebert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker, Moritz Siebert, and I, Niels Kaastrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we also attempt to answer your questions. Now, if you're tuning in for the first time, welcome. We love that you're here, and we'll do our best to make it worth your while and hopefully entertain you along the way. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Morning, Jerry. Good afternoon, Niels.
Same. How are you? How are you guys?
Same.
Great.
Yes, we're still alive. Tough week, but we're still here. So, speaking of tough week, let me just sort of talk a little bit about what caught my eye. Of course, no doubt, it's the global sell-off in fixed income markets that really intensified this week, causing for sure significant give back of this year's earlier profits for trend following strategies. Certainly also on our side, we'll come to that. So I was kind of just looking up on one market just to get a reference point, and I noticed that the drop in yields we saw in Bund futures from the beginning of August. And now we're back to exactly the same levels, now where we are in sort of mid-September. So it kind of correlates pretty well with what's happened also performance-wise, but we'll dig into that a little bit deeper. And this is, for people who are new to trend following, I would say this is really how it normally works. We also saw a very similar period where we had a strong period in October 2017 all the way through January 2018. And then again from November last year until the end of August this year. And then in between, we have these correction periods, some more smooth than others, but they're certainly there. And of course, these opportunities, from an investor point of view, sometimes they're, pretty good in terms of getting into the strategy. It's an opportunity to buy in, below the high or the most recent high. But of course, we as human beings often never really get to that point where we pull the trigger because we start thinking in possibilities rather than probabilities, which is, of course, one of the weaknesses that we as humans have, especially when you look in the research of behavioral finance. And speaking of behavioral finance, I just want to take 1 minute to quote a guest that I had in an episode I released just a couple of days ago on the podcast, and it's Dr. Daniel Crosby, who is not only a behavioral finance expert, but also in the financial industry. And one of the things he said, every single way that we have evolved for immediacy, we've evolved for certainty, we've evolved for action. Success in financial markets takes dealing with uncertainty. It takes restraint. It takes patience. It takes not listening to your gut. Our gut was originally the original risk tolerance system that was our gauge of how we ought or ought not to behave. The first thing we need is just to recognize and be aware of just how ill-equipped we are for this. And I think this is really important, especially when you go through a period, as we did last week, that can cause a lot of emotions, of course. Now, clearly people who've been around for a while, they've seen this before, but I think we also should recognize people who may be new to trend following, and maybe even new in terms of investing in trend following. And I think we certainly can recognize that it's a tough and volatile introduction to this way of investing. So if you are one of those and you have questions for us, as usual, just send them to info@toptradersunplugged.com, and we'll do our best to answer these questions. Of course, also when we have these periods of time that there's a lot of headlines and narrative in the press that comes out, and certainly this week I've seen a number of them blaming CTAs for being behind these vicious sell-off. I'd love to hear when we talk about it, whether you are the ones selling. We've done a little selling because we have to reduce risk when these things happen. But I just think overall, it's wrong to try and blame this on CTAs. First of all, we're not the ones starting counter trend moves. And we're still a relatively small industry, $340 billion managed by the industry. And we're looking at a bond market that has trillions and trillions of dollars in it. So I really don't think that it is correct to say that. But I do understand that it's a great headline and narrative to put out there. So funnily enough, by the way, we never get the praise when markets go up. It's also a very predictable human behavior, I guess. So Moritz, with all of that in mind, how are you doing on your side?
Nicely terrible. So I was just saying I'm doing great when you asked. I'm not so sure. Well, I'm doing great. I'm smiling, but the week in trading was tough, real tough, and down a bit more than 10% really, and all of that was unsurprisingly driven by the bonds. And, I kind of like caught myself in the middle of the week with like the third or fourth consecutive down day in the bonds, kind of like, now it has to stop. It has to turn around. There will be a reversal, right? Only to be disappointed on the Thursday. And then there's another smack hat on the Friday. So it's one of those weeks where it just doesn't work. And you're just sitting there and watching the performance, deteriorate. And well, that's what it is. But to your point, Niels, on the selling, don't blame me. I didn't do any selling. I didn't touch a single bond contract this past week. No vol controlling. No stop has been hit. I mean, of course, the stops are getting closer. If it continues the way it did in the past week, then, stops will be hit. But for now, they have not been hit. And so I just need to sit there, trust the system, and continue to push the buttons of the mouse if and when a signal comes up. But if it doesn't come up, it doesn't come up, and the portfolio stays unchanged. So I took the hit, like I said, 10% down. There's been a couple of markets that have produced positive performance. The emissions contract, for instance, I think I made some money out of silver, but all of this is minuscule against what the bonds did to my portfolio. So there we are. Let's see what happens next week.
No, absolutely. And I really think that's an important insight, right? Someone like you not touched one bond. So a lot of, again, just goes to the point that when you see these headlines in the news about CTAs selling, et cetera, there are so many people involved in these markets. And, CTAs, certainly the medium to longer term CTAs, it's questionable. Certainly when you have a sell-off straight from an all-time high, it's a sharp one and a quick one. It's questionable how much we will really participate in the beginning of that. But, certainly on our side, just like you, more, it's a tough week, month to date, giving back what we made in August. So, if you took out August and September so far, no change since July. But of course, we always focus on the most recent high, and therefore it's tough to look at. But as soon as you expand the lens that you look at these things, and we don't look at daily, weekly, monthly, or even yearly numbers, but you just look at that 5, 10, 15, 20-year horizon, I see a lot of consistency in the return profile of the strategy. And, for us, of course, it's the bonds as well that caused the drawdown so far this month. To put it into perspective, we've probably given back a little less than a third of what we've made in bonds so far this year. So we're still massively up for the year in terms of profit from bonds. And as I mentioned, because we do things a little bit different to you, we've reduced a bit of the exposure. That's how our systems operate. But thinking back to February 2018, where we had a similar kind of short-lived, sharp, violent correction, not a crisis, in my view. The right thing was really to stay with the positions. I mean, it all recovered later in the year, but it's painful. And again, you have to just follow the process, as you say. This is what we like about being systematic. It's that we shouldn't be emotionally involved. Certainly not on the decision making during periods like this. bonds, main loss, of course, as I mentioned, we lost some money in Japanese equities, pound, coffee, cotton, lean hogs. I mean, there was a bit of a list this week. And of course, as you say, small positive news came from things like crude oil, U.S. equities, the VIX, cocoa, soybean oil, but nothing that could really stop the bleeding during the week. As I wrote out to my clients this morning when I did my weekly synopsis, I mean, for those who have been with us for years, decades even, it's not the first time this has happened. It won't be the last time, and that's how it is. So yeah, but I have been very interested in your response to this week, Jerry, because of course you have stated many times that you look at the bond sector a little bit different to us in terms of how much exposure you want to give it. So I'm curious to hear how your week was.
Yeah, I mean, I didn't make all the profits in the bonds like most others, and so I didn't have quite the give back either. So it's just been the best market for a long while now, and it's the gift that kept on giving until now. So, who knows? It could go back to the highs or keep going lower, but I think it's really just a question of how many bonds do you have. It's a pretty vicious sell-off. We trade, all of us have systems that have historically made lots of money, and according to those systems, it's still not, if you want to make that money, you have to follow those rules, and according to those rules, it's still in an uptrend, or it's still worthwhile to have on those long positions. So I don't even think that, from my point of view, all of us differ a little bit on the way that we say things and handle things, but my risk in that trade was my small loss of 50 basis points, and so that there's not any increased risk in the trade. The risk is gone. So just because it's high vol and sloshing around and making me feel bad, it's still a trade with no risk because it's massive profits in these bonds, and they're just no fun and uncomfortable. So I wouldn't even cut back based upon risk. Most of the time, a lot of the trend followers just totally ignore this volatility on mega profits. So I'll continue to do that. But I'm very keen, though, on exiting these things when it looks like the trend has turned around. And, maybe some more of this. Some of my less traditional exits based on trend will have me reducing some of my position. But yeah, it's just the number of bonds you have on, and the amount of money that you've made so far in this trade is going to determine how bad you feel about this week. So just typical stuff.
Yeah, we were certainly talking about it before we pressed record, and at the end of the day, a lot of it comes down to kind of your portfolio construction, right? Because it just happens to be bonds are super liquid, and there are many of them. So we tend to have a lot of them in our portfolio. If there were 5 different gold and 3 different silvers and all of that, we would have more of that. And those moves would feel more painful or great, depending on which way we were on that. But so, yeah, I mean, it is what it is. And as long as people can tend to ignore the headlines and the sensation that will go around a sell-off like that. And frankly, if you look at the news flow, even though we tend not to, but I couldn't help just looking a little bit at what was being given the reason. I mean, you look at some of these risk factors like the trade war. Well, the trade war was certainly a lot of good news during the week. So it's clear that the risk premium for where people have been seeking shelter in bonds, I mean, that's going to go out. It's quite normal. I mean, it's not normal that rates were falling at the pace that they were. So, yeah, I mean, I also see this as normal market behavior. So, anyways, before we jump to kind of the next items on our list today, we don't have a voicemail today. There was no messages in the voicemail box this week, sad to say. But if you do want to leave a voicemail, maybe a message of support for 3 struggling trend followers this week, you can do so at toptradersunplugged.com/voicemail. We certainly appreciate hearing from you guys. Maybe one of the few last updates on our live event. We've got like 1 or 2 spots left if you want to join us in October 26, 27 in New York, and for us to help you, with some breakthroughs, hopefully within trend following. Check it out. toptradersunplugged.com/live is where you get some information. So, busy week in the markets. How about social media, Twitter in particular? Jerry, was it a busy week as well?
Well, it's been 2 weeks, so we have built up.
Oh, yeah. We've got plenty.
Yeah, we have a few things. I went back and looked. I was just, thought I had a lot of good stuff last week, but then I looked at them again and I was like, not that great. It's okay. So, these things sometimes don't age well, but Wayne to the rescue this week. Wayne has provided us with a lot of good stuff, good quotes, things to think about, because he did a nice interview at Real Vision, and he has lots of fans, and he has lots of things to say. So let me find the Wayne, get going on where Wayne was talking about.
While you look for Wayne, I just want to say I saw a lot of nice tweets and comments about our episode last week with Peter Borish. People seem to like it, and also a very nice, kind message from Meb Faber. We appreciate that, and for sure, Peter was a great guest and very fitting for our 1-year anniversary. So if you haven't checked that episode out, why don't you do so? And again, just a selfish plug for the interview part 1 with Daniel Crosby. Go and check that out. It's really good, and part 2 is equally insightful. So did you manage to find Wayne in your Twitter feed, Jerry?
Yeah, this one got the most amount of interest this week, actually, of all the tweets. Kind of an interesting thing, and I have no problem talking about things that we don't necessarily fully agree with or understand, but my Twitter followers like this one a lot, and it goes, my discretion is very systematic. It's a rules-based discretion. I don't know what it means to be fully discretionary. Before I get in, I know my stop, a profit target, or trailing stop, but it's all in my head. So, I've often thought that guys who are not maybe systematic trend followers still can use some of these tools and implement them in a kind of their own systematic way.
I was listening to the interview with Wayne, and of course, great interview. But I have to say, I was a little bit also confused, meaning this blurred line between systematic and discretionary. And I'm just thinking, if things are so systematic or rules-based in someone's mind, why not just program it? So there must be a little bit more to it than just saying, well, I have all the rules in my head. And I think he did say that he can bend the rules, so that's how his discretion pops up. It's not so much no rules, it's more bending the rules, and maybe that's impossible to program. But I find it a little bit confusing sometimes when people talk about themselves being systematic, but then it turns out that it's not programmed. It's still just in someone's mind. It's maybe with Peter Borish on last week, where we really talked about also the how successful someone like Paul Tudor Jones had been as a discretionary trader. Peter was very clear, but there's discipline behind the method. So I guess it's possible, but I think it must be hard to be that disciplined all the time if you haven't got the rules down.
Yeah, I like the interview with Wayne on Real Vision, and what he said about the systematic discretion reminded me spot on about our conversation with Peter Borish, because it was kind of like the same discussion that we had with him. Where is that line? Where is the difference between discretion and systematic? And if the discretion is systematic, why not systematize it completely and put down the rules and trade that way without any discretion? Now, I mean, I'm from Wayne, from that interview in Real Vision, I gather that, he's trading options. That's what he said. He's, buying options. He's buying convexity, buying skew, buying vol. That is how he trades. Now, in those markets, and, I trade a lot of options myself, and definitely have traded a lot of them in the past. Those markets, it may be difficult to systematize everything, just because it's not just the settlement price of a futures contract, which is like one single print. It's a complete volatility surface. It is more complex data in that space, right? And therefore, systematizing it completely is probably more difficult than what we're doing with the trend following system, which is using linear instruments, futures, ETFs, equities, etc. I'm not saying it's impossible. It's probably more difficult to do. And maybe that's why, and I'm just guessing here, I don't know the answer, but maybe this is why, okay, you have the rules in your head, you know, this is what you want to do. You want to buy an option, a put or a call if volatility is down there, or if this and that happens. But, you know, you don't have it programmed, because trading those in those markets, in those option markets, may be difficult to have a computer do. Maybe it's, you know, you want to be point and click and go to the market and put limits in, and, or, you know, call a broker and ask for a good price, or trade OTC, things like this. I don't know how he's doing it, but that would make sense to me, and I can see that point.
Yeah, no, I agree with you, but I will just add to that for me, being systematic doesn't mean you have to systematize fully your execution. I mean, on our side,
Agreed.
We have traders.
Agreed.
We have traders who do it's just a signal they get. It's their decision how they want to implement the trade, so to speak. So, but I think your points are very valid, and hopefully we're not too far off in what Wayne meant and what's the reason behind. There was a whole bunch of great quotes from him coming from that interview for sure.
Yeah, he talks about a paper in that interview that I found and I posted, and one of his comments is that to be aware of a high success rate in trading. So, you know, we talk about our trade win percentage in the 40s, and so I think he sort of gives the impression, I'm trying to understand, that if your win rate is higher, then maybe you have a negative skew where your wins will be smaller than your losses, and he thinks that's a bad idea, and that at the end of the day, you will have to pay the piper. You're taking pleasure now, but you'll receive pain in some time from now, which we kind of all understand. And we've had the pain of giving back some profit on some really large winners, but I think what he's describing is like even worse, not having those winners and having at some point in time having to realize bigger losses. He goes on to say, I've learned over many years that I just don't know, and I literally don't care. No one has any idea what's going to be in the next 6 months. It's all much larger than ourselves. So many variables. It's all confounding. We can't extract or isolate what the influencing variables are. And for me right there, that's why following trends works. It's just too big. We've just seen it over and over, that predicting and trying to understand and get to the bottom of it. And Wade even says to the interviewer, like, who looks at things a little bit differently, it's okay that you're trying to figure out what's going to happen, make some negative performance or negative moves in the market, but I don't really even care. I just want to be prepared for those negative moves and know that what I'm doing is going to help when bad things happen. So this is just music to our ears, and I think it's another thing that taking small losses and having diversification, a lot of the similar characteristics of successful traders, even if you're not trend following, I think this is another one. Just don't try to explain anything. It's beyond, it can be too big.
I like that. I fully agree. I mean, it just makes no sense. It's a pointless exercise to figure out, why exactly something has happened in those large markets. It doesn't make you a dime more money if ex post, what has happened and what the reason was for a certain move. It's yesterday's news. And none of us know what's going to happen tomorrow or in the next 5 minutes or in a year from now. So it's really all this talking about what is driving a market, why is this happening, why is that happening, is really just probably a waste of time to say it very direct. And to Wayne's point with the negative skew, if you have a win percentage rate that is greater than 50 or 60 or 70, I think that's true. you will probably have negative skew if you are up there, because those are the mean reversion, short volatility, all those type of strategies, which, when they hit, it may be terminal pain. It will be the end. Whereas we have, 40% win rates. We have kind of like ongoing pain most of the time. We are in this state, but we're unlikely to go bust because of that.
Yeah. Actually, in my guest this week, Daniel Crosby's previous book, I think he cited a study between systematic and discretionary trading strategies. And I don't know the details of the study, I'm just paraphrasing, but it's something like what they found was in 94% of the time, systematic would equal or outperform discretionary. And I think this is quite important. And also, if you just look at the top 10 hedge funds in the world, I guess, how many of those are discretionary? Probably none. So, but of course, the financial industry is really tied to also what happens in the media, right? And you can't really have Bloomberg or CNBC invite guests that all the time says, I don't know, I have no idea where the S&P is going, It just doesn't sell. Story sells, narrative sells, predictions, as wrong as they may be, sells. But deep down, people have no idea where the S&P is going to close this year, or the VIX, or wherever it might be. But this is part of this. This is why I'm so fascinated by behavioral finance, and I think everyone should be reading up on this. I think this is one of the most important things we can do as investors. We have this tendency that we want to be precise. If you ask people, how many, I think he mentioned in some conversation where sort of how many books are there in related to the Bible. People will come up with all sorts of guesses, like 27 books or whatever it might be. They have no clue how many books there are. Turns out there's 66, but I had no clue. I didn't know. But that's just how it is. Instead of saying I don't really know, maybe 50 to 100, then at least that's a range. But no, we would always try and guess something precise. And it goes back to the same thing we say about trend following all over and over again. Good enough is good enough. We shouldn't try and create that model that will be the best model, because there is no such thing as the best model. It is a range of probabilities that we work with, but if you put them together, they become stronger as a unit.
Yeah, and later on we can talk about a study and a tweeted that pretty much said the same thing, that within a range, all of the medium long-term systems that they tend to make about the same amount of money. So we've got every market may having the same expectation, basically, from a trend following point of view. We have markets that can't stand on their own long only, and historically they haven't had profits, but if you trend follow them, they make money, and they will make about the same as all the other markets. So now we have proof or evidence that the systems can make about the same amount of money. Whatever the Sharpe ratio, the average Sharpe ratio over all the systems is probably your best guess for what each individual system is going to do. So it just gets better and better for our side in living in this crazy world that's where crazy things we've never seen before continue to happen all the time. And, at least give the CTAs credit. They're long these bonds when everybody thought a year or two ago that the obvious trade was to be short the bonds. So we make a lot of money, and we have a tendency to keep it. And this week will be forgotten so quickly as nothing. It's nothing. It's just a little blip when the final story is written about 2019.
Yeah.
Very good point, Jerry. I reminded of myself of that yesterday, when Friday evening, the week was over, finally over. It felt like it was finally over, right? And it's like, when those weeks happen, I've had them before. And like you say, Jerry, in a few weeks' time, it'll be in the history books, right? And your mind stops being in the, it's no longer concerned with what has happened. So I'm trying to force myself into a good feeling, saying like, looking back at all the trading that I've done in the years, there have been so many great periods This is just, this is not about the money. This is just numbers going down. It's, the chart goes down, but I'm kind of like actively trying to force myself into some sunny period where, I've been making that money back in 3 or 4 or 5 days, right? And it kind of like, it feels like nothing has ever happened. And I've also had worse periods than the current one. So it's kind of like, I'm trying to find a balance. We're in this hole now. This has been a real rough week, but come on, maybe in a month's time, we'll just be on the podcast and speak about this horrible week and go like, well, we've made now new highs, and you just forget about the thing.
It's all about the mental game, right?
And that is
the
an
mental
important
game is
game.
so important. It's an important game, and
do not freak out right now.
Right. Yeah. And one way of looking at it, again, something I also looked at, not necessarily this week, but very recently, I was looking at rolling 10-year performance of our strategy versus bonds and equities. Bonds, of course, we know in the last 30 years have been going up. So, of course, we expect 100% of those 10-year rolling periods would be positive. But actually, our program never had a losing period over 10 years. And actually equities, where people think, oh yeah, long-term equity holding, long only, you're going to be always making money. Actually not. 92% quote unquote only of the rolling 10-year period since 1984 was positive. So yeah, so you could turn it around and say, at least in our case, and I'm sure it's the same for you guys, no one has ever lost money in trend following if you just have a 10-year view. But every month, every week, every year, of course, yeah, we can have a down year.
Who wants to have a 10-year view? It's all about today. Recent, so that's another edge we have, was that we'll have a 10-year view. That's why I've said before, put up your weekly chart. So put up a weekly chart and look at 10 to 20 years worth of data, and then put your channel or your breakouts around that, or whatever your moving average. Adjust your parameters, divide everything by 5, and you can look back and you see these trends are just enormous in all these different markets. And those periods, just like this week, that were nothing. They either went to new highs, and or it was a signaling of a great new trade going in the other direction. And the most important thing was to get on that trade and do it. And you just don't have the capability to view those past periods that maybe were even worse than this week with any sort of concern, because you're looking at history, and history worked out well just by following those trends. So in the same way, we'll look back and we'll just never be able to get this level of anxiety that we have today. But weekly charts, they're soothing. A lot of trends out there. A lot of volatility, but in hindsight, as long as you followed your rules, that didn't really seem to matter very much, and stayed incredibly diversified. We're just so diversified. It's going to be almost, it's going to be difficult to have long losing periods.
You cannot simulate the pain. You cannot replay the pain, right? You can look at the chart, your own track record, and you'll easily find periods in that track record that have been worse than this week. Even in terms of consecutive down days. That stuff is in there. And the longer we play, the longer we survive and stay alive at that game of trading, the more of those will be in there, right? So you kind of look back objectively and say, this has happened before, and therefore I should be prepared to experience at least the same going forward, right? Just be ready for that. But you cannot replay the pain. You cannot simulate the pain that you would have been in 10 years ago, because your brain isn't able to do that. You can only feel today's pain. And then you think, you're kind of like trapped and think, this is so bad, it doesn't get any worse than that, and, I need to change and do something. But no. You don't have to. You just have to, I guess, close your eyes and follow through.
Well, you can't backtest experience, and experience is what will, and I think this is something that is so understated when people look at track records, because some people will think that just because it's new and it's the latest and greatest, that it is, better. And of course, then they're going to look at a long track record from people who've been in the trenches for decades, and of course, they will probably have bigger drawdowns, and they won't look as smooth. but they have that level of experience that you can't buy, you can't get any other way than doing it day in, day out for decades. And it is that experience that will keep you, as you say, Moritz, that will keep you from making silly mistakes.
It's the same like paper trading. Like some people, they paper trade, but paper trade isn't the real thing. Like looking at your past track record is kind of like paper trading the pain, but you cannot do that. You have to be there with real money and make the loss and feel the loss, and that's the only way to gain experience. There's no simulation for that. There really isn't.
Yeah, I mean, I look at it a little bit differently. I think the best thing I got from my experience is when I didn't follow my systems, I lost money. It was worse. So I'm going to limit that experience to that and that only, because I think that sometimes living through experiences successfully gives us the wrong impression. So I think that if a CTA started today with no experience whatsoever, but somehow could muster up the discipline to do every single trade and have a medium to long-term system and trade all the markets the same way and have a diversified portfolio and to do shorts, I think they would have a huge edge. But if you need this experience to force yourself to be disciplined, then I'll accept that. But I do think also living through different periods of doing the wrong thing can give you false confidence. And actually, if you're a new trader or an inexperienced trader and you make it through bad periods and someone says, how did you know to take small losses? How did you know to go with the trend? How did you know to be so diversified? How did you know that would be what it took to live through these things? And you'd say, well, of course I knew those things. It was never a question of whether I knew them. I didn't need a moment's worth of experience to know that that's the way to go. That's the safe way to proceed. But I do think learning the hard lessons of what happens when you don't follow your system and follow your rules, regardless of how average they might be, is the best and maybe the only type of experience that I value, because I definitely think somehow living through 2008 and taking lessons from 2008. No, there's no lessons from 2008. Zero. The only lesson is follow your system.
I think that's a great point, Jerry. Absolutely. Well said. Should we do a few more tweets if you want before we've got questions? Some very relevant questions I might add. So let's do more tweets if you want.
Let's do one more. I think okay. I like this study out that I saw this week from Spring Valley Asset Management, and it was 4 tweets. I'll try to summarize them, but basically it was just another research paper that came to the same conclusion that CTA performance over the past few years is weak due to the lack of trends. But it went on also to say that this analysis that they saw no CTAs just have a tendency to make money all the time. It didn't really matter if stocks were going up or down, if volatility was high or low, or if correlations were high or low. None of this sort of explained performance or were indications that performance would be lower than normal. There were some periods where maybe low vol is better than higher vol, but none of these environments cause CTAs to have poor performance or not make money. And that's certainly been my experience as well. We just always have a positive expectation, and it's just rare to go through periods like this where performance is less than we'd like it to be and less than average. But when it happens, it's just pretty much going to be due to the lack of trends. Bad timing on my part because this has been a good year. But it's nice to look back and try to understand what's causing our underperformance.
Yeah, and I would add to that, it's not necessarily just lack of trends. It's also just a pause and correction in trends. I mean, who knows? Next month, Trump might change his tune and tweet something, and suddenly these deals on the trade tariffs war is gone, and bonds will be heading higher again. I mean, who knows, right? So, yeah.
Well, just I see here one from Wayne that I particularly liked a week ago, and he got a lot of likes on his Twitter account. I just retweeted it, but he says, in investing and trading, everyone talks about mitigating risk, while one of the biggest risk is in fact not taking risk. There's something beautiful about calculated risk, like favorable asymmetry. Risk is a requirement of success. Don't mitigate the right kind of risk. And so what I take from that is do the trade. It's nothing more important than doing the trade. You did those bond trades, that A+. It was a big trade. The trend was up. It made no sense. Rates are getting close to zero. No one else is doing them. How could you possibly have known and predicted? You couldn't. You don't have to. You followed your breakouts and your moving averages. And just doing those trades, where would you be today if you had not have done them? What kind of, and that's why it's so important to just follow your rules and follow those trades. And in my opinion, equally as important, that's where you're going to get out of these trades. You know, it's a crapshoot where you're going to get out. Who knows if they're going to keep going lower or they're going to rally to new highs. But you don't have the benefits of these profits if you are too afraid to put the trades on. So I really like that.
Isn't that spot on? You know, he says there's a risk in not taking the risk. And I think this is just perfectly said. And it reminds me of one of the things that I tell my friends all the time is, they ask, well, here we go. We have to mention Bitcoin on each episode, right? But they're still hesitant. They go like, I'm afraid to touch it, and it's a scam, and people use it for the wrong things and that type of stuff, right? And it's like, well, I think there's a risk. There's a real risk not being long the thing. I'm not saying put all your money into Bitcoin. There's people that do that. I'm not a fan of this, right? But a certain amount, a certain percentage of your portfolio, I think the risk of not having it is greater than of having it, because, who knows what the thing's going to do. Does it go to 100,000, to 1 million? I don't know. Nobody knows. Does it go to zero? Yes, maybe, right? But there's a real risk of just not being exposed and taking the volatility of those coins. And I think it applies to all the other markets too. Not being in those is a risk. And Wayne is just such a great resource on those philosophical, the way he puts it is just fantastic. We all always agree, but he has an art, he has a real skill of, saying them in such a nice way.
Absolutely. And also I think maybe we should put this week in perspective a little bit. Obviously, it's been the focus of our conversation, as it is every week. And when you have a tough week like this, we did see the biggest rise in yields in a week since 2009. That's bound to happen. Every 10 years you get a big surprise, and it came against the trend. So it's bound to be painful. It has to be. So,
by the way, other things that have been really painful this week, things that I am not exposed to, so it wasn't a pain to me, but I've read about it. And this is the apparent reversal of the momentum value spread, where for the past month, years, weeks, the momentum stocks have outperformed, and value was kind of like battered every time. And that spread has reversed significantly and quite violently, I've heard. So it's not just been the bonds. I think there's been other players out there in the markets that have had taken a hit without it coming from the bonds.
Yeah, so I saw that in my stock portfolio, and but once again, all I did was put together this portfolio, trying to find as much diversification as possible, and so I have some longs, shorts, and some flats. So I must have had some value. I must have had some momentum. Whatever. I don't even know what these terms even mean. I just had all different kinds of stocks. And so I had a couple of my stocks sell off and a few ATRs from the high, Starbucks, Walmart, Coke, McDonald's, whatever. And then I was buying new breakouts, and I'm like, okay, whatever. You want to call it value? Maybe, I don't know what's going on. I'm just saying If you start with a portfolio that is not diversified, and then you'll try to figure out a way, well, I'll switch really quickly. Yeah, you're going to get hurt. You're going to get hit. But the pursuit of max diversification in every areas of your portfolio is going to bring these type of rewards where you just shrug your shoulders. I don't really see this pain because I'm not overloaded when what they would consider to be momentum, I guess. So a fun week in just looking at those stocks. One of my new friends started trading stocks this week, and for the first time, just trend following stocks. And he called me up and he said, so every time I look at the Dow, it's up, but all my stocks are down. Is this a problem? And I was like, boy, you're in for a good journey. But I said, no, keep going. You just do the trend following thing, and you're going to have periods like this.
Yeah, absolutely. Okay, let's maybe turn our attention. We can always come back to more tweets if we want. Let's turn our attention to Sam. And this is so funny because Sam actually sent this question on the 4th of September. Because of last week we had a guest, we couldn't do it. So you're going to laugh when you hear this message from Sam. So he starts out by saying, happy 1 year. I wonder if each of you might be able to recall the largest up or down moves in 1 day, week, month, year over the course of your entire careers. Jerry has provided some of this in the past, so maybe he can provide further anecdotes, memories, trying to have fun and hear what kinds of wild moves you have lived through over the decades and memories of your most vivid experiences. I think that's a pretty good question for this week's episode. Maybe we've already answered it, Sam. I don't know. But Moritz, what is your memory of some vivid moments in your career?
So, I mean, this past week, but then January 15th, 2015, the Swiss franc. That was a crazy move. So that's still in my memory. I probably won't forget that ever. And there have been massive moves in my portfolio in the 2011-2012 period when we had the Euro crisis, with equities being very volatile, some of the currencies being very volatile, Italian bonds being very volatile. I can also remember back to the Lehman Brothers periods, 2008, fall of 2008, the winter of 2008, where we had some crazy moves in the equity indices, like, -6, -7% days. So I've all been there, and but it's like we said. I mean, even this 2008 period when I was trading back then, it felt there was a lot of you felt it. It wasn't probably that much pain because for the most part I was making money out of those trades. But I mean, large moves. But the Euro crisis, I've lost money, but I'm sure I was in much pain as I am this past week. But yeah, it's for the history books. It doesn't matter anymore. But I can still remember it. So I've certainly had days like -5, -6, -7% days. Yeah, if that helps, Sam. And it doesn't feel great if that happens, and it's even worse if you have 2 or 3 in a row.
Yeah, no, I mean, like you, there's been plenty really along the in the last 30 years or so. One of the things I do remember was sort of back in 1994. I remember there was sort of in the late summer a couple of really tough months for trend followers. I think after some kind of rate decision that surprised the markets. I was attending one of the industry conferences in Chicago. I can't remember if you were on the panel, Jerry, frankly, but certainly Keith Campbell was there, John Henry was there, and so just listening to people who had been in the business even longer, certainly at the time longer than I, kind of just taking it pretty easy about these things, even though certainly on our side at Dunn, that period was sort of 2 months of double-digit down months, so it's painful. But no, I mean there has been plenty. I agree with Moritz that the financial crisis felt different because you wouldn't just worry about the market moves. You would actually worry about whether the system would collapse, whether your collateral was still safe in the bank. Those kind of issues, I think, are quite stressful. But I'll be the first to admit it's still not easy to go through a severe drawdown. I don't find it in any way, shape, or form enjoyable or easy. And but going back to the process, going back to the numbers, as I mentioned a couple of weeks ago, maybe back in December last year, we didn't know at the time November would be the low for this previous drawdown, but just doing this kind of drawdown analysis, looking at the average period it takes, looking at the average depth of these drawdowns, looking at average expected recovery periods, and seeing it play out completely in 2019, it gives me tremendous amount of faith and confidence in the strategy. So yeah, I mean. Sorry, I can't be more specific, Sam. I mean, but there's been some crazy moves along the way. Big down days, big up days as well. Of course, it's not just on the downside. We talk about big moves, generally speaking. You get challenged on the emotional roller coaster from time to time. But hopefully. These conversations will help people listening to us, not lose faith in the strategy. And I think the three of us enjoy having conversations on a day like today where we can just kind of check in with each other and say, yeah, tough week, but, as you say, in a couple of weeks' time, it'll be forgotten and we've moved on. Jerry, crazy moves? Well, I guess you have to go back to the turtle days for really crazy moves.
That's right. A lot of crazy moves, crazy profits, crazy givebacks. But I think it's important to think, what have I learned from those crazy moves? Was I trading too large in general? Yes. Was I too concentrated? Maybe in too much of the bonds, too much of the grains? Probably, yeah. And then what am I going to do? If it bothers me, then do something about it. And then sometimes it'll just be, how do I navigate the need to have long-term systems, but not have big givebacks in my profits? What am I going to do about that, in this trade? So I think just asking those questions and getting your overall leverage correct and your portfolio weightings correct and what are you going to do with big profits that have had a vertical move straight up, that's subject to a lot of give back. So these big profits in volatile periods and big daily losses serve to make us ask the right questions. And I think they're important. I was thinking the other day, Moritz and I have sort of had the same similar backtesting characteristics that it seems that if the average period, whatever the average return is, our drawdown might be at least twice that. And so I was thinking, how many times have I asked myself, I haven't had that big drawdown, haven't had that 20%, 25% drawdown in quite a while. Where is that drawdown? Oh, no, we're not asking that question. No, it's a characteristic of the system. The system's great. We love it. It's fantastic. It's a culmination of our life's work. We don't want to talk about that. One of the biggest characteristics, it's bad luck or we're going to jinx it. But when it happens, do we sit back and say, that's the system. It's right on time with that twice the drawdown. No, but that would be totally logical to sort of just not be emotional and just know that thing's coming and it's working perfectly. The big drawdown is a signal that everything's right on time.
And I would just add to your question, Sam. I think maybe one of the reasons why I don't really recall that many specific sort of big drawdowns when I see your question is actually just as we've said earlier, we kind of forget about it in a few weeks' time anyways. It's not something we keep holding on to. I mean, when I was referring to it before, it's because I also was looking at track record and see, okay, I remember that period and so on and so forth. But frankly, if someone asked me, it's not something that I, just have as ready knowledge, because I don't focus on that. It's about the long run, and the long run is pretty spectacular when you look at these track records. But you had a follow-up question, Sam, you sent, and that goes, another question for this week or next week. I know most hold positions in equities, both long and short, but some take a long-only approach. Maybe this isn't strictly unique to equities, but it seems to be the most popular. In your opinions and experiences, do you know why this is? Is there a situation where you would find this approach sensible or correct? Moritz, what say you?
What say I? Good question, Sam. We've said it on the podcast that, most of the money comes from the long-sided trades. So you could say, well, let's trade long only, long neutral, and avoid the shorts. But as far as I'm concerned, I think for my portfolio, that would be too short-sighted. I like the diversification that I get out of the shorts at specific points in time. I realized that, looking back, the shorts haven't performed as well as the longs. Doesn't mean that it's going to be exactly like that going forward. So I do want to have the shorts on. And the other part of the question was, some people like doing that, or they prefer doing that. I often come across investors who have difficulties trading short. Maybe they don't trade derivatives or futures contracts. They trade, physical stock, and then they would have to borrow the stock and, pay seg lending fee, and then maybe call on the stock, and it's just not within their mandates, or they're kind of like either long or they're out, and maybe it's coming from that circumstance that they're doing it that way. But no, I will have the shorts on. There's no question in my mind about that.
Yeah, on our side, we make no distinguish between long and short. We have no bias. I understand why people, maybe in particular in equities, say that or choose to have a long bias in equities. Clearly, they go up more time than not. However, as Moritz says, there's no reason to believe with certainty that that's always going to be the case. And also the shorts provide opportunities at very important points in time. So we wouldn't want to be without them. But I'm aware of the situation, Sam, that you highlight. Any thoughts from you, Jerry?
It's just, different way of doing things that long only fits in with their story of owning quality companies and looking at fundamentals and value. And so our story is quite a bit different, which is ignore all of that, go with the trends, try to get as much diversification. Don't even just trade stocks, but if you're going to trade stocks, shorts are going to help out a little bit, and they may make a lot of money and certainly add to diversification. So it's just two different worldviews that can't be connected in any way. Of course, the majority of people look at things much differently than we do.
Very true. We have a question. Thanks, Sam, for your question, as always. We have a question from Bruno. Bruno says, it's a completely different question, I would say. So he says, what are your thoughts on using cash versus continuous contracts to develop and trade systems? The price difference from cash to continuous is huge. Sugar is an interesting recent example because it is at an all-time low on the continuous contract, but the all-time low on the cash contract was 2.74 back in 1972. Also, is there a way to value a commodity ? On a stock? You can use various valuation formulas and ratios in order to value a company as expensive or cheap. Is there a way to do so with commodities? Well, who wants to jump in first?
Let me start. I don't concern myself with the valuation. That's point A. So I'm not sure if there's a way to even value a stock correctly, right? You may say there's discounted cash flow and this or that, but a second later, the thing trades at a different price. So, what is the value? Because if there was a definitive way to come up with a value for anything, then that would be the price, and the price wouldn't change all that much. But, it's trading, so the perceived value apparently changes all the time, which makes me think that, well, it's not that easy to find the real value and the true price for really anything. And therefore, I don't do it. I don't concern myself with it. I just follow the price. Now, with the cash contracts, I mean, with the way we trade, we test our systems, right? We come up with a back test. We build a statistical body of evidence. And it's important to me that that body of evidence uses the same instrument that I will trade going forward. So I want to do the test on the stuff that I will actually put position and risk on. I don't want to be looking at the cash markets of some commodity and then trade a futures contract that is 3 months or 4 months away from that cash market, because the futures price may be very different than the cash price. So I really want to be testing the things that I will actually be trading.
Exactly. I think some of the prices of cash versus futures would be different. I see that on the currencies, especially sometimes. But if you're trading cash, then run your system on cash. If not, but futures does have this kind of benefit that sometimes you can make more money if you're in a futures contract because of the way it's moving around. And I remember our first big trade in 1984 happened to be short sugar, and it would go short at 3 cents, and it would go down to 2, and then we would roll till the next month back to 3. So we just kept making this differential between the markets. So it's I doubt if you ran a back test on lots of cash data or futures data, I think the back test would probably be about the same, But don't think there's a lot to be gained by focusing on either exclusively.
Yeah, and not surprising. I tend to obviously agree completely. I mean, I don't think you can really test something unless you use a continuous contract. You have to do the roles. You have to take them into account. Unless, I guess, if you were an intraday-only trader, then maybe you could. But other than that, it's easier, I think, more realistic to use continuous data. So hopefully that answers your question, Bruno, and thanks very much for that. In terms of valuing a commodity, I think there are ways where you can try to see if something is relatively expensive or relatively cheap within the same sector. So in the grains, you could probably do that. I don't know how to do it myself, but it's certainly something that we've looked at as well on our side. But I don't. It shouldn't detract you. I think from being a trend follower, I think there's more money to be made on that side than trying to figure out within a sector whether one market is over or undervalued.
I've said on panels. I mean, I know 2007 or 8, I was on a panel in New York with Fundamental Commodity Trader, and it was the panel was to discuss trend following technicals versus fundamentals in commodity markets. And this guy was honest enough to say, that the big move up in copper in 2006 was a monster move in all the LME markets, that he was short the whole time. He'd got on a plane, gone to the different mines and looked it up and done his analysis, and it's right to be short. And we were long all the time. And I said, I feel so guilty because all I did was buy the breakout. And here you were working really hard to try to understand copper. And of course, at different periods, he'd say, well, you took 4 losses in a row in copper. I never took those losses. I'm like, sure, yeah, I take whipsaws. And that's the negative part about trading the way we trade. But I doubt if human ingenuity and fundamental analysis is going to be reliably better than a moving average crossover.
Yeah, and I think to that point, I think we've talked about this a number of times. If you ask people a year ago, they would probably say yields were pretty low and they shouldn't go any lower. There's a lot of, and here we are. So often the best opportunity for us as a trend follower really comes at these extreme situations, right? Where we see yields suddenly drop, 5-6 weeks in a row very rapidly. And then that's where we can really capitalize with a trend following strategy, where most value, if you took it as a value trade, I think you would be probably on the opposite side of that trade, and that would hurt tremendously. Obviously, you would have had a great week last week, but you may not have been in business if you've had 5-6 weeks or 5-6 months of this rally going against you first. So anyways, that's doesn't mean people can't find ways to do both, of course. Any other tweets, thoughts? Let me just quickly run through some of the numbers for this month so far and for the year, and then maybe you come up with some final ideas to talk about. So as of Thursday, so not including Friday. Friday was not a good day as far as I can tell. So as of Thursday, the B-Top 50 index was down 3.32, up still for the year 8.86. SocGen CTA index was down 3.67 for the month, up 8.05 for the year. SocGen Trend Index down 5.95 for the month, up 12.81 for the year. SocGen Short-Term Traders Index down 1.06 for the month and up 2.02. And finally, the Bridge Alternatives Index down 4.9 for the month, up 11.01 for the year. So, yeah, looks like it's pretty much in line, relatively speaking, to our own experiences, giving back most of, if not all, of the August gains so far. But we still have a couple of weeks left, so plenty of time to change that in both directions, of course. Any final thoughts? Any topics, articles that you want to bring up on your side?
Well, I don't know. The most liked tweet of the past 2 weeks, I'll read it to you. I don't even know if I understand what this really means. So it's kind of funny. There's an old saying, how do you know when a trader is losing money? When he starts researching the stock. So kind of made sense to me from a trend following point of view. Like I have some stocks and some of them have been going down a lot recently. So I haven't started researching the stock. But I am still losing money. So I guess you always try to redouble your efforts. And when you put something on and it doesn't work out for you. But that kind of a funny quote. But I don't even know if I know exactly what it means.
I don't know either precisely what is meant by that, but here's a thought. It's often, when you hear about things, let's just say we take a stock like Apple, lots of news flow come through Apple, but as long as you don't have a position in it, it's just news, right? As soon as you get a position in Apple, all that news, because something you feel you have an opinion on, and you start thinking that, oh yeah, that must be right, that must be wrong, and therefore this must happen, this something. So I think definitely there's something to it that as soon as, and so it goes back to also a little bit about transparency. So because we, I think generally as an industry we're quite transparent. So there's a positive side to that. There's a negative side. The positive side is, of course, that your clients can see what's going on in the portfolio. The negative side is as soon as you show them that you're long this or you're short that, they have an opinion on it. And often that opinion will be different to our position, right? So I think there is this, that, you can get into an awful lot of trouble as soon as you start researching something or as soon as you have a position, because suddenly your opinions change in terms of how well you think you know this stock or this market. I don't know. That's just sort of one thought.
Could also be that you're looking to to find confirmations for your own position, right? You double your research efforts in order to reconfirm that there has been a valid reason for you putting the stock on. Now it's not working. You're losing money, so you're kind of like going back to the research side of things, and you're trying to reconfirm that you're doing the right thing. Well, but it's I'm not 100% sure what it means.
Yeah, so you can tell the story when someone asks you.
You can tell the story. That's right.
And so our point of view would be, don't do any research. Take your small loss. Get out of that sucker. Buy it again if it goes to the highs. You didn't know why you bought it. Your reasons for buying it in the first place may have been totally misplaced.
Absolutely.
If you're buying something for any reason other than it made a new high, I can't help you. You're in no man's land. It's not going to work out well. Stop doing that.
Well, the other thing I wanted to say is, before we're closing this down, to all our fellow trend following friends out there, keep your heads up high. If that has been a tough week, if you're following the system, you're doing everything right. Don't freak out. and happy trading next week.
Absolutely. I think on that note, let's wrap up this conversation. And if you want to support 3 struggling trend followers this week, then please head over to toptradersunplugged.com/review, where you can leave a review and a rating for us. It helps the show just to get discovered by more people, so we appreciate that. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you on the next week's episode of The Systematic Investor. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode.